Today, we're going to be talking about the difference between REITs and physical real estate and which of these you should invest in. For the purpose of this video, when I say real estate, I'm talking about physical real estate like the house you live in, the apartment you rent, or the shopping center where you do your shopping. And when I'm talking about REITs, I'm talking about public companies on Wall Street. So if you want to invest in real estate but you are unsure if you should invest in real estate directly by buying physical property or indirectly through Wall Street, this video will help you understand the positives and negatives of each, and then you can decide for yourself which investment works best for you and your investment goals. Now, if you don't know what a REIT is, it stands for Real Estate Investment Trust, and it is a publicly traded company that owns and in most cases operates income-producing real estate. REITs own many types of commercial real estate ranging from office buildings and apartment buildings to warehouses, hospitals, shopping centers, and hotels. And even though REITs can own many different types of property, they will typically specialize in one area. For example, there is Simon Property Group who specializes in malls, then there's Public Storage who specializes in self-storage properties, next you have Welltower who focuses on healthcare properties, and then there's Avalon Bay Communities who focuses on residential properties. When you invest into a REIT, regardless of what property type they invest in, you are entitled to part of the profits, and you get those profits in the form of dividends. This means you can become a small owner in a $30, $50, or $100 billion real estate portfolio, and you get to benefit from their massive scale and take part in the profits, all with as little as $100 and maybe even less. So now that you have an idea of what REITs are, we can look at the pros and cons of REITs and physical real estate to help you decide where you should invest. Let's start with the pros of investing in REITs. One of the benefits of investing in real estate through REITs is the easiness to get started. Because REITs are traded on the public stock exchange like the New York Stock Exchange, all you have to do is log into your brokerage account and you can buy REITs just like you do with any other stocks. And if you don't already have an account, you can go online and sign up with a broker, and it only takes a few minutes to fill out some basic information, and after you fund your account, you can begin investing. This is much easier than going out and getting qualified for a property, dealing with the sellers, and doing all of your due diligence before you close on the deal, and because of this, just about anyone can begin investing in REITs. Then a second benefit of investing in REITs is the low barriers to entry. What I mean by this is you can begin investing with $100 and sometimes even less, since many trading accounts let you trade with as little as $1 and you can buy a full share of certain REITs with less than $100. So you could theoretically begin investing with a few dollars. Also, there's more and more accounts coming out with features that allow you to buy fractional shares. For example, if you wanted to invest in a certain REIT but their stock is trading between $600 and $700, and because you're just getting started with investing, you don't have $700 to buy one full share, you can still invest whatever you have and buy fractional shares. And this is great for young people who want to get their feet wet but don't have tons of money available. Now, the next benefit to investing in REITs is that they are liquid. What this means is you can buy or sell shares in a short period of time, and this is especially true with all the technology that is used for trading. Since brokers have thousands of accounts, they can easily take the shares you sold and turn around and sell them to another buyer even when one person is in New York and the other in San Francisco. Now, if I was talking about the pros and cons of REITs 100 years ago, then liquidity would be a big con because one, REITs did not exist 100 years ago, and also back then, stock owners were recorded on paper and not electronically, so it wouldn't be easy to sell your shares on a moment's notice. And the reason why liquidity is a good thing is that if you go and invest $10,000 into one or more REITs and a month later you need some of that money back for whatever reason, you can't just log into your account, make a few clicks, and you have access to that cash again. Now, the fourth pro to owning REITs is that there isn't any physical work required. Once you buy REIT, it doesn't require any ongoing maintenance or renovations. If you go buy some shares in Simon Property Group, you become a partial owner, but it doesn't mean you're going to get called into the office Monday morning. This isn't the case with owning physical real estate, because if you buy fixer-upper, there will be tons of work you will need to do, and you will also have recurring maintenance on that property, which can get pretty involved. Obviously, you want to do some research before you invest in shares of a REIT, and that does require some effort, but you will also want to do research before you commit to buying physical real estate. And on top of that, you will have to schedule repairs and deal with tenants on a regular basis, which is not the case when you invest in real estate through a REIT. The next advantage of investing in REITs is the low transaction fees you pay when buying or selling shares. Depending on which broker you are using, you may have a fee of a few dollars, which is not bad, but there are many brokers out there that don't charge any trading fees. And at the end of the day, the less fees you pay, the more money you have available to invest, and even small amounts can add up. And then the final major benefit of investing in REITs is the limited liability you have. For example, say you invested $5,000 into a REIT and then the company goes bankrupt, causing the shares to drop to zero. In this case, the most you can lose is a $5,000 investment. So even though you were an owner in that company, you will not have anyone coming after you for more money because the company didn't have enough to cover its liabilities. This is not the case when you own physical real estate, because if you have a mortgage that is higher than what the property is worth, then you are on the hook for that difference. Or if the property you own is underinsured and it burns down or something like that, then you're going to feel that loss directly and you will not be protected behind a multi-billion-dollar REIT. So those are the major advantages of investing in real estate through a REIT. But now we are going to look at some of the major downsides of REITs, and the first one is the lack of control you have over how the business is run, how the properties are managed, and the share price. Even though you are an owner of that company, when you buy shares in a REIT, you don't have any say in how things are done. Yes, you do have voting rights, but unless you control major amounts of shares, no one will listen to what you have to say. And this is probably one of the biggest downsides, because if the people running the company are doing illegal things like overstating income, or if they are bad leaders who run the company into the ground, then you end up losing. Then you also don't have any control over the price movements of the stock. Say the REIT you invested in is doing great, but because a lot of people treat investing in stocks as gambling, you have prices going up and down for reasons that don't have anything to do with the actual business. And for someone who hasn't been investing for a long time, that can lead them to make irrational choices. And that leads us to the next major downside of REITs, and it's that emotions can play a role in your investment decisions. For example, let's say you were looking to invest in either equity residential or Avalon Bay communities, and after you did some research, you decided equity residential was a better REIT to invest in. So you invest $5,000 into that REIT, but a week later, equity residential is down and Avalon Bay communities is up. Now you're going to be second guessing yourself, and there's going to be a bunch of other emotions going on. And it can even get to the point where you sell your equity residential shares and buy Avalon Bay shares, only to realize equity residential is up and now Avalon Bay is down. So you can see how it can get very overwhelming and frustrating, especially if you're new to investing. And even though many people invest in REITs for income, it doesn't mean they become immune to the price fluctuations. So that's why you still see irrational behavior when share prices drop too much. So those are the major benefits and downsides of investing in REITs. So now let's move on to discussing the main benefits of investing in physical real estate. And the first benefit that you get with physical property is that you get something tangible. Unlike REITs where your asset only shows up on a screen, real estate is physically present and you can point to it, walk inside it, and live in it. You can even get multiple uses out of your property. Let's say you go buy 100 acres and the main reason you bought the land was for the timber. Well, you have that timber, but you can also use the land for hunting, fishing, or you can build a house on it. Also, for some reason, real estate was to become worthless, then at least you still own the land, the structures, and the resources, which is not the case with REITs, because if the shares go to zero, then you're left with nothing. Then the second pro to owning physical real estate is the tax benefits. Real estate is one of the best assets to own when it comes to tax benefits. You could be making thousands of dollars in income from your properties, but you can report a loss on your taxes, saving you tons of money. And there are quite a few ways to do this, but a big one is using depreciation. Now, this is not an actual expense that would take money out of your pocket, but it is a way to reduce the amount of taxes you pay. And the second major tax benefit is called a 1031 exchange. For example, if you invested $100,000 in some REIT shares and after some time they are worth $500,000 and you decide to sell them so you can invest in a different REIT, you will pay taxes on that money once you sell. However, if you bought a house for $100,000 and now it's worth $500,000 and you want to sell that house to buy another, you can do a 1031 exchange and take the money from the first house and buy a second house without paying a single dollar in taxes. And you can continue this for as long as you want without ever paying taxes. And as I said before, the less you pay in taxes, the more money you have available to invest. Now, the third benefit of owning physical real estate is that you can use leverage to buy property. So instead of having to pay for a $100,000 house in cash, you can give a fraction of the price as a down payment and use someone else's money to cover the balance. And this is great because you can use as little as $3,500 to control a $100,000 property. But the best part is, if that property were to increase in value by 5%, then you don't just make 5% on the $3,500, you make 5% on the $100,000. Now yes, you can buy REIT shares using leverage, but you will never be able to buy $100,000 worth of shares with only $3,500 out of pocket. So where leverage is really beneficial is with physical real estate. Now let's talk about some of the cons of owning physical real estate. One of the downsides is the high amount of work that is required to maintain your property. If you decide to buy distressed property, then it's going to require a lot of time and effort to remodel that property and get it ready. Then after you rent it, you will have regular maintenance that you will have to do as the owner of that property. If a pipe breaks, then it's on you to fix the pipe along with any other damage. If your tenant doesn't pay rent on time, then it's on you to get a hold of them and collect, which can be a pain, especially if they are bad tenants and are not willing to pay. Then if it gets really bad, you will have to go through the eviction process, which can be an even bigger pain depending on where you live. But it doesn't stop there, because if the tenants left the property with holes in the wall or damaged floors, then it's on you to do all those repairs, and even if you hire a property manager and contractors to do the work, you still have to oversee them and make sure they're doing what they're supposed to. The second downside of investing in physical property is the barriers to entry, which is especially true in areas that have high real estate prices. When it comes to investing in REITs, you can get started with a few $100s, but when we are talking about physical real estate, an investment property might require a 20% down payment. So even on a cheap $100,000 house, that's still $20,000, and many people cannot come up with that money easily. Then if you look at housing prices in Southern California, you could be looking at over $500,000 for a single family house. And with a 20% down payment, you're talking about $100,000 up front, which again can be very difficult for many people. Then another downside of physical property is that it is not a liquid investment. Unlike REITs, where you can log into your account and sell your shares with the click of a button, the same cannot be said of physical property. Before you sell a property, you should at least do cosmetic repairs so that it shows well, but even doing small repairs can take over a week. Then there is still a chance a property sits on the market for months, and after you accept an offer, it can still take around 30 days to complete the legal process. So if you need money as soon as possible, it's going to be hard to access it, not to mention all the selling costs that you will have to pay. And that brings us to our next downside, which is the high transaction fees. When you're buying physical real estate, you're going to have what are known as closing costs, which includes escrow fees, lender fees, and inspection fees, to name a few, and these can easily run into the thousands. Then when you sell that property, you have to pay commissions, title fees, and escrow fees. So if you bought a property 6 months ago and something in your life changes and you need to sell, you could be throwing away thousands of dollars in fees alone, which is not the case when it comes to selling REIT shares, because on a worst case scenario, you will have to pay a tiny trading fee and you will have access to your money again. Now obviously there's many more benefits and downsides to owning REITs and owning physical real estate, but these are the main ones. That being said, if you are someone who is young and you have limited resources, or if you are someone who is new to investing but you still want to benefit from investing in real estate, you can begin investing in REITs and then progress to investing in physical real estate. However, if you are someone who has more experience and you have the resources to invest in physical real estate, then you can do that. Like many other topics in finance, the answer to the question of where you should invest isn't so black and white, and it all depends on your situation and your financial goals. But now that you have a good understanding of the benefits and downsides to REITs and physical real estate, you can make a better decision of where to invest. And with that being said, if you enjoyed watching or you found any of this information helpful, it would really help me if you like and subscribe. Thanks for watching, and I will see you next time.